This is Justin Pulitzer. This is my weekend review for Sunday, September 20th, 2015. I have a good amount of material to cover, so I'm going to just jump right in as usual. So this week we had the Fed, and there had been a lot of fear leading into that Fed decision that the Fed was going to raise interest rates. A lot of the TV talking heads were saying it was about a 50-50 probability. But if you looked at the Fed funds futures, it was roughly about 70-30. And I've been saying for a while, for a cacophony of reasons, that I didn't believe the Fed would raise interest rates, and I had proposed on multiple occasions a what I dubbed as the hashtag lower for longer thesis, and that played out. I don't want to get into too much of the Fed comments, but they said that they think that the job growth is kind of solid, which is ironic, but they mentioned that they have been noticing that the labor participation is not good. I believe the exact term they used was below underlying trend. Yeah, no doubt. The quality of the jobs that we've had in this country for a while are not good. It's mostly service industry jobs of waiters, waitresses, bartenders, carnival ride operators, although that's seasonal. I don't think that I've only heard Janet Yellen once mention that she is starting to see kind of more structural unemployment, and she basically was just, talking about technology. That was in her testimony a few months ago over the summer. Anyhow, some of the reasons they used was that they didn't see inflation. They haven't been reaching their 2% target. They haven't been reaching, they cited global growth, particularly China slowing, that the energy sector has been slowing, with drilling in particular, that we're having problems with our exports, the trade deficit, and the weak dollar. All of this is stuff I had mentioned, and all of this stuff I don't see changing rather quickly. Janet Yellen was fairly dovish in her Fed testimony. In some of the Q&A, it was said that she was a little bit more hawkish. I don't believe they're raising for the rest of the year, although they did give some kind of, they said that the dots, the other Fed governors are seeing a higher growth rate. These guys have been wrong on growth since the get-go. They've been overestimating the growth rate, so I don't necessarily know if they're going to make that up. I've said in previous occasion that the first quarter GDP was very weak. A lot of the strength in the second quarter GDP was sort of people who were making up for purchases they hadn't made in the first quarter. So let's see how that third quarter comes out. She talked about some widening risk spreads, basically between the risk-free and the kind of the junk. That has been a bit of an issue. It isn't nearly what it was in 2008 or 9, but it is widening slightly. And she listed a schedule of where she thought interest rates would be: 1.5% by 2016 to 2.5% by 2017, and the end normalization rate of 3.5% around 2018, which is consistent with lower for longer. As we know, 6% is the full normalization, and they will be well below that. Anyhow, now that we got the Fed out of the way, let's discuss the markets and what I'm seeing here. So I have a chart of the VIX up. I've discussed a couple of items that I believe we need to see sort of go the right way for the stock market to go higher. And those are the VIX being below 25, taking crash risk off the table, and then kind of having 22 to 20 as the upper end of the risk range in terms of the VIX, with 25, of course, being the absolute max. Anything above there, I believe, puts crash risk into play. You can see when we closed above 25 here for the first time, we nearly, I should say not nearly, we more than doubled it the exact next day. That was the flash crash. And then subsequently, the tide of fear has been receding. I do believe that we're going to see something like this, where we need to see the VIX prove itself, that it can make lower highs before the market can kind of stabilize. So we held the tail line of VIX support, the new tail line of VIX support, which had sort of been a middle ground in the past, and we have rallied up there. Friday, we did close below the 25. We closed in the 22s, which is still rather elevated volatility. but we did close below that key 25.20, the old level, I just say 25, and that is a good sign. However, there are some concerns that I still see, and I'm gonna discuss that. My thesis, though, like I said, is that the VIX may need to come back up, make a lower high. It is possible maybe that it does want to fill this gap up here to 40, which would be a fairly elevated panic level of VIX. I think it would be really healthy if this did wind up rallying back up and stalled around the 31 and then kind of collapsed back. We'll have to see how that goes. I am not that super bullish on the market in general here, and I'll discuss why. One of the other major ones that I've been discussing, not the CD, the DX, the dollar, the good old greenback. That is good, what we have been seeing. We have been in a down channel, really more of a consolidation pattern. And here, for the first time, we collapsed below the 200-day moving average. But the problem is, on Friday, we rallied back up basically to about there, and we're kind of just chugging. This is still dangerous, in my opinion, for a rally still higher in the dollar. This is the reason why we're having problems with our trade deficits. This affects companies that have earnings overseas. Think Apple, think Facebook, think Nike, think any large corporation with any significant revenue, or I should say business overseas. A stronger dollar makes their profits lower. If we had if the Fed would have hiked here, you probably would have had a spike in the dollar, and every time the dollar goes higher, that means earnings estimates have to go lower. If you can have a dollar that kind of just chills out or still trends lower, I do believe that would be good for earnings, and that will result in higher stock prices. So we have to keep that in mind. The other way to follow the if you don't trade in those futures, just look at the UUP. That's the ETF. Let's stick to the ETFs for these for as much as we can. But if you take a look at the UUP, you really want to see that continue still lower. The next one would be the ZBs, but let's talk TLT. I have a few Fibonacci retracements on here. I'm sorry if the chart looks a little bit muddled, but it is good here that we are seeing the bonds rally. I've had a few people ask me, oh, bonds are rallying, that means it's bad for the stock market. That is really foolishness, because we all know that stocks are the valuation of stocks is determined by a discounted cash flow model, and a very key part of the denominator is the risk-free rate, treasuries. So the lower that numerator is, meaning the lower interest rates are, the higher the end product is, meaning the stock price. Also, in an environment with higher interest rates, meaning lower bonds, the price to earnings multiple for stocks will recede, meaning people will pay less for those earnings because they can get more return for their buck with the risk-free instrument, which would be the bonds. So this is going the right way. The key hurdle here is the 2009 flash crash high, the 123.15. I honestly don't really even need to see the bonds super duper rally. You just don't want to see them really collapse and go lower. I mean, hanging out and chugging, sideways would be very healthy, I believe, for stock valuations and PE multiples that people are willing to pay. One of the other major ones, of course, we know is oil. We are sort of in a little bit of a bull flag pattern here, although it is kind of showing a little bit of weakness. You could see the 50-day moving average has been a key level. We got up above there and then subsequently fell back a little bit below. We're kind of just pinned between the 20 and the 50. If this does wind up breaking down, I would say 37, somewhere between 37 and 33. I believe this is trying to bottom. I don't believe the thesis that oil is going to 20. I just think that the amount of the supply has increased over the last few years, with major advancements in horizontal drilling and hydraulic fracturing and the ability to get at oil and natural gas, and also the fact that the Saudis are sort of in a market share war and they are pumping like mad. We know Iran oil is coming onto the scene. So I think that the slowing world economy along with increased supply has depressed the price of oil. At some point, I do expect to re-see the 74-ish, 75 level. That's really, you can see where this major breakdown took place. and we'll take it from there. I'm not sure what the order of operations are, if we're going to kind of rally up to see that, or if we need to kind of retest the lows or just muddle some time before then. I don't necessarily know if it's going to be a spike up there, but I do think that it is possible that that happens. Keep an eye on Exxon. This is sort of bear flagging, believe it or not, a bit. We are below some key levels here. These 76s are important. We're sort of, I guess, a bull flag within a bear context. I do believe that this is trying to bottom. I do believe that the mid to lower 60s will sort of kind of be it for Exxon. I don't know if we're going to see 55s again. I do believe that they are going to have some amazing opportunities with buying companies that have been in, are having financial trouble. I do at some point expect this to rally up and retest sort of the breakdown area between 83 and 86, where it goes from there. Round and round she goes. Where she stops, no one knows. I don't know where she's going to trade after that, but it would not shock me to see that. It is also possible we do want to come down and retest. So just keep an eye on Exxon. I've been sort of using this as a global proxy, oil for the global growth proxy, and Exxon would be the stock to do it with in terms of that. It's the strongest one and the one I think has the least chance of a dividend cut. Speaking of which, that was one of the things the Fed had talked about. They were worried about, I guess, companies and their, the layoffs that are coming. I think the Fed is aware that companies will probably do rounds and rounds of layoffs before cutting their dividends if possible, particularly these oil stocks that view them as sort of sacred cows, as they should, frankly. You need to see some FXI stabilization. The good news is we made a higher low here. We made a slightly higher high here. We are kind of coming back into some range. There could be some gap fill action here. I've been playing this with some put ratios. I don't know if those expired or not. I'll have to check. I'll be more than happy to put them back on. I do believe that FXI probably could see lower, but there's been a lot of damage. If you're looking to short, of course you want to do it on rallies. I think somewhere up around this 50-day moving average around the 38s, you can see there's some volume between 38 and 40. I believe a rally up there could be some row short action. You can see there was some failed support here, and that could set up. If we do wind up coming lower, I'll probably be looking to play this for more bouncy type of action than shorting type of action. All right, so those are the keys that I see to the market. The VIX, the dollar, the bonds, the oil, and China. Let's get into the market indices. SPY. So look at what had happened here. This was a rather large liquidation break we had. You can see here we closed below the range, and then the following Monday we had the crash, the flash crash that took us down to these reference lows around the 181s. Since then we've been kind of bear flagging. I know there has been a lot of hope and optimism in this. I have said that I did believe I still believe where there is going to be an end of quarter rally. I'm going to discuss what that might look like in a moment. But look where we kind of were pushing into, where the resistance was sort of forming right around the old volume distribution. I had said that I thought it was possible on some type of a move. We might re-see this 50-day moving average in the 204s. Instead, we only got up to around the 202.89 to 203, which is sort of like the tail end of that, the upper support. And it was weak. We couldn't get there. You can see we had this sell-off after the Fed was kind of... You ran up into the Fed. I said that I thought the risk-reward was shifting. I said on the stream to a couple of followers, I thought we would see pop and drop, and that's what happened. And Friday, we not only we had a bit of a gap down, but we sold off and closed below the more controlled downtrend, and also the bear flag, sort of the rising triangle, and we closed down in here. If you take a look at the expected move as it priced in by options, it's about $4.62. On the downside, that would take you just below the 191s to 190.83. Look around where this gap fill is. Look around where sort of the close here was, the 189.5. We could fill up the triangle down to here. It's possible we also retest the all-time low here and fill up the triangle all the way down. So anything below, I believe I had said this was the range that I thought was going to be key for the rest of the year, the Fed day range. So anything below the 199s is more bearish. Anything above the 202s, 203s to me is a little bit more bullish. You could extend if you want to use this 2-day range. Anything I think inside of Friday's range is going to be really choppy. I don't know that if it necessarily needs to be played. I really believe that below here, you're sort of looking to more sell the rips. Above here, you might be looking more to buy the dips. I have a few stocks that I'm a little bit more bullish on. I have some that I'm not. I will discuss those. But I do believe that it is possible, given this snap, that the risk is a little bit lower. The path of least resistance is unfortunately showing lower. We could have still yet another leg down. I've discussed maybe even retesting the 2000 and 2007 peaks, so that to me is still potentially possible. If there is failure, and this is pattern failure, and we do come back up, I do think we would wind up filling the gap here rather quickly to the 199.73. If you factor in that $4.62, that's about 200.07. So that is roughly around here. So it's either the sort of the filling up the triangle back down to these reference lows down in here, or up here to fill the gap. That is that's SPY. IWM, on the other hand, is also has been showing a lot of more relative weakness for a while, with a series of lower lows and lower highs. We stalled just above the, just below the 50. We are closed below the 117. First of all, we are well below the 120.58, which is sort of the breakout area. We are well below the 117.37. You can see we kind of tried to look above there on Thursday. We closed at 117.34, just below there, so that was, of course, signaling more weakness. I do think it's possible that we could see some more weakness down into sort of these reference lows. I don't know if we're going to test the all-time extremes, but it is possible that we do wind up coming down. The Qs have been sort of a little bit more relative strength. You can see this did stall at the 50, 100-day moving average confluence. It did test up higher. The bars here aren't as bad. We're still in this sort of upper distribution. You can see these were really the reference lows here, and we're not below there. That to me is a little bit more bullish. Let me draw a trend line here. You can see if we drew it from, let's just say here, we're kind of just peaking below, not quite as definitive of a snap as in the SPY. So I wouldn't say bearish. This is a bearish pattern, of course, but I would say that the Qs are showing a little bit more optimism than the SPY. I do think around the 99s probably finds some reference support. The key to that, as we all know, are the big momentum stocks. Apple, of course, being the most important. It's a very large portion of the Qs. Apple has been showing a lot of relative weakness. It came down. It broke the 119.75. It kind of tried to retest and has just been making lower lows and lower highs. This could be forming some type of an inverse head and shoulders pattern. In the past, before the split, the 20-day moving average has been really important for Apple. That has become a little bit less important. Post-split, the 50-day has been the more important one, and we couldn't even test up there. I believe that 115 is really key. Anything below there, I think, could have the 111s, which is the 20-day moving average in play, potentially the 109s, and then maybe even to come back and retest into this area around the 103s to 100.72 down here. So I would be looking on some early weakness. If there is some weakness in Apple in the week, I'd be doing kind of put ratios, like buying 110, 109s, maybe selling 105 or below for some type of a retest back into this area. You can see that's also primary trend line down around the 103s now. So I do think that that would set up really well. If it does wind up rallying up and taking out the 116s, 117s, I do think the 119s probably would be retested fairly quickly. But do keep in mind that the 50-day moving average is now sloping down. The 100-day is now sloping down. The 200 is starting to roll over. However, the 20 is sort of starting to stabilize. So let's see how that plays out. Google just kind of rallied into their earnings, sold off a bit. Here was the split up of Google, filled the gap, and is now kind of just chugging along in this consolidation pattern. I don't really know that there's that much to see, although I would say Google, if you're long, this roughly around the 50-day has been key. You might want to try it for right or right out. I do believe that put ratios in this sucker will be great. I like the idea of buying some put up higher here and then selling puts down below here where the real breakout took place, the 183s. You can see this low got close. It didn't quite get there to the 193s, but I do believe that that would work out really well for some type of a play for a retest in Google. If it does wind up taking out this spike high, we probably will see, the 700s again. That's going to depend a lot on the tape. A lot of my analysis here is tape contingent. If the tape really softens up, even the bull stocks are going to have some problems. Above 92s I see as being bullish in Facebook. Could use the 50-day moving average as a stop if long. I do believe that put ratios in this type of a name work out really well for pullback type of plays. You could see in the Fibonacci retracements, I believe that am I doing this right? No, I'm doing it wrong. Hold on. Oops, hold on one sec. Sorry about that. I think I've drawn enough of these that I would know better, right? All right, so this is 72, I believe, that low. Sorry, I just want to make this correct numbers so that people are, if they're going to set their alerts or their, buys, it's roughly correct. If there's some type of a move down, I think selling, buying puts up here, like, for the gap fill here, like the 88s or the 90s, and then selling, either 83s or 81s, which is really where the breakout took place. You can see between this 85 and 81, those are the big fibs here, right? The 83 to 80, 81-ish. I believe that these being your sort of terminus lower put strike would work out really well. If you're playing for a move higher, I believe that call spreads would be the sort of the better way to do it. If you are looking, down here, you could see if it does wind up rolling back over, maybe sell some out of the money puts and buy some calls or call spreads for some type of a risk reversal for a move back higher. I do believe Facebook has still higher to go, but again, really market contingent. Twitter, a lot of people keep talking to me about this being a buyout target. You're still below the old reference low of the 29.50. I think the CEO is sort of the appointment's going to be a bit of a wet fart. Sorry to, be too graphic, but I don't really think it's that big of a deal. It's not going to save the quarter. They really need to start showing some user growth, and until that happens, I believe it's going to be a bit of trouble. I do believe that on some type of rumors or news, you could see some spikes up into these 34s, 35s, maybe even it wants to fill the gap somewhere around the 36s. But this stock clearly has, its work cut out for it. I do have a little bit of it long just for a kind of a crapshoot here. I would say that I'll probably be using the 26.42. Anything below here will probably be a good area as a reference for a stop. But I think Twitter at the best is dead money for a little while. Some of the other stocks that have... Netflix is another one that is, I think, showing that it could want to roll back over to see lower. I've been talking about put ratios or doing call ratios. You can see that like a back spread for like lower, like if you bought the 94, 95s and then sold either the 85, the 85s. I've been doing 85 and 80 a lot because that's a that would be the resolution of this head and shoulders. It's also sort of where this breakout took place. I do believe at some point Netflix could retest the really large breakout here of like the $70 level. You can see it was a point of contention for a while with tops here. The here was a little bit lower, down to like 65, but this was the top here, this was the top here, and this is really where it took off from. Wouldn't shock me to see some type of a rollover retracement into that area. I do like put ratios for that. If you're doing call ratio, if you want to do call ratios, maybe play for the gap fill here to the 115s. I think I had been saying to buy the 109s and sell the 113s or the 115s if you can get those off for some type of credit. I believe that the break even was going to roughly be around this shoulder top. So if you're playing for like some type of a move back up, that might work out well. I actually like playing both ways, sort of playing both long and short. You can see that we're kind of coming back down in terms of the stochastics. It hasn't quite gotten below the lower band. It is just sort of consolidating, but below 103.88 to 105 to me is a little bit more concerning bearish. You can see we did squeeze up here to 107s, but in the end we did close below 103.88. I don't think that it's a long unless it's above 103.88. Anything below there to me is still suspect and iffy. Tesla, been strong. I had said that I thought anything over the 242s where Elon Musk did the secondary and bought in was solid. I thought we'd re-see the 265s. We did. We saw a little bit of responsive selling. I do believe that this is probably a buy for right or right out on the 50, 100-day moving average confluence. If you're bearish, as it comes in, maybe play with a put ratio where the one, for like some type of a gap fill down here for the 224s filling, buy something up here and then sell 2 times as many down here. If it does wind up coming down on some, on a larger market move, maybe sell the 205, 206 puts. I do think that area is probably solid for at least for a little while. There is a gap to fill around the 191s, but I don't necessarily think that that's in play. I just think on weakness, it's a buy the dip. I wouldn't, of course, be chasing into strength, not on a downtrending tape, but I do believe it is still a buy the dip stock. One that was a little out of order here, JetBlue, look at this, still making highs. This stock is really bullish. Also a buy the dip stock to me anywhere, if it comes back down into some reference areas. You can see that the 50, roughly around the 50 has been kind of key, trading on either side of it. So maybe if you get to the 50 or below it, sell some out of the money puts as a long proxy. Some of the stocks that I've been really, really critical of, and I refer to them as the silliness, are AMBA, GoPros, the MBLYs. I guess Twitters could be in that kind of genre at this point. But, these stocks have shown, which had been these are kind of bull market stocks. They don't really do well when a market turns over, and we are in a more of a bear market these days, right? So I had said in last weekend's video not to press shorts, that I thought that there would be some type of bounce in these stocks. We were coming into 61.8s, coming into trend lines. It stopped just ahead of there, but the bounces have been rather muted. You can see this kind of whole excess has been taken back. I do believe that there could still be some more downside in these, but you really want to see them rally, maybe like get up at a gap fill up here, back kind of like where like this reference low was, like 93. There's a gap fill somewhere around 89, somewhere in there, I think would set up as like a great right or right out short, maybe something against a trend line touch if there's some type of a pop. Now that we're down, I'm also down for put ratios, buying something down here and then selling something still lower, maybe down around these reference lows if you can get that filled. I like to do the same week or the following week. This week might be a little bit slow because we have the Kippur holiday, the Jewish holiday, the Day of Atonement and fasting on Wednesday, so there might be some light volume sort of midweek. Not sure how that's really going to play out. Maybe there is some type of a bounce back. We do have the end of the quarter coming up soon. I do believe that there will be some type of a rally for performance makeup. I believe that you don't really want to step in the way of that, and probably a move down will be an opportunity to short-term to buy. GoPro, I've heard a lot of stuff, people talking really a big game about this stock, at Apple or Google are going to spend $6 billion to buy them. In what planet is anyone spending $6 billion to buy these people? Cisco Systems bought Flip Camera. I don't know if you remember those a bunch of years back. They were like this really simple camera that you kind of just pointed, pushed a button. It was almost like a child's toy. I actually, believe it or not, loved it. I used to use it a lot kind of before the iPhone camera really got more sophisticated. But at this point, I mean, how many extreme sports enthusiasts are duct taping a GoPro onto a helmet or onto handlebars or jumping out of planes? What's the replacement cycle for these? These are really expensive cameras, $300, $400, $500, $600, and there's no subsidies. I mean, once you kind of own one, you don't buy another one. It's not like an iPhone where there's a new, really important new technology that comes out every year. A lot of people have been saying that this is going to be a big deal because of their social media, but I don't know. 37s here. I did think that I had said that I thought this was kind of going to be bullish for a bounce to 37s. It's been rather weak. Maybe it gets one of these upper Fibonacci retracements. It would be amazing to get back up to like 48s to like 52s to kind of re-short up here. I would love to do it into like this confluence of moving averages. The all-time low down here is around the 28s. I do believe you could play some put ratios with that area. I would even use a put below this lower strike because I do think it's possible that it pops through to get even still lower. MBLY, downtrend, one of my silliness types of stocks. I did say here that on this day that I did think that there was some covering to be done, that there could be a bounce. It did have the bounce. It's still below trend, and it's sort of rolling over again. So if this one does want to rally back up, maybe into the 53s where this sort of breakdown took place, there's a big, sort of memory around the 53, 54s. I'd be looking to short, particularly if it comes in to play with the 50-day moving average. That would be amazing for a good right or right out play. Also, another one I do believe could come back down, to see still lower. But we'll see. It's just been this sort of listing lower. Not one that I'd be too keen on. If it does wind up breaking the downtrend, very short term, I do think you could play for a bounce long. But, again, I'm not really a huge fan of these stocks. They're more bull market type of stocks, meaning when the market's making higher lows and higher highs, not lower highs and lower lows. That's the kind of market you want to, own stocks like this into. Anyhow, I believe that we covered enough. I really wanted to keep this video a little bit maybe shorter. Be sure to follow me on Twitter. My handle is @JustinPulitzer. If you like this video, just hit the thumbs up like button. Please subscribe to my channel. You'll get notifications when new weekend review videos are posted, Periscope rebroadcasts if you happen to miss those, and special edition videos. Anyhow, let's have a good week, and cheers.